Hey everybody, we're back. It's Dan from Create Capital. Welcome to my channel, and we've got a great video for you today. I have found a sleeper stock, and I'm so pumped about it. So I'm going to share it with you guys right now, and yeah, let's get into it. So the other day I was looking at a new mouse and a new keyboard for my own setup at home. And funny enough, I found this keyboard. It's called a Logitech MX Keys, and I absolutely loved it. And then I was thinking, this is really cool because I can switch between computers using one keyboard. I wonder if there's a mouse that can do that too. So I went out there, I found a mouse, and it was just so happened to be a Logitech mouse as well. And it's wireless, absolutely love it. So I have these two products now from Logitech that I really like. Actually, my mouse pad is a Logitech, and I didn't even realize it for the longest time. And it got me thinking, I wonder what Logitech stock looks like. So I went online, did a little bit of research, and the first thing that stuck out to me on this company was that their PE ratio was like 14, which just seems really low in general for being in the tech industry, and especially nowadays with everything being so inflated. So I said, okay, let's do a deeper dive. So I built a discounted cash flow model for it. Went through the whole analysis to try to figure out what this company was worth, what the stock price should be, see if it was undervalued, which is what I suspected it may be. And it turns out this is super undervalued. So let's take a look at the discounted cash flow model I built, and I'll give you some of the highlights. So if we take a look at the earnings, look at 2018 to 2021, you can see that there's a steady increase in 2018 to 2019. These are in thousands, so 281 million, 342 million, 373 million in 2020. And then 2021, so this is March to March. So March 2020 till March 2021, which obviously was like all COVID time. So you can see that huge boost. It's a big jump. So looking forward, I said, okay, well, I'd say this company is probably going to grow pretty aggressively, but I want to be really conservative. So let's go with a 10% per year just to be safe, because they're historically growing before COVID. On average from 2018 to 2020, about 10% a year, which is 21% and 9%, the average of those two. So I use that as a go forward. So what that ends up yielding in that net present value of your future cash flows is about 3.4 billion. I made a couple of assumptions. So I used a multiple of around 14 for enterprise value over EBITDA. And if you look out there, you'll see a whole bunch of different numbers. I wanted to use a number that was similar to around what the PE was for the company. I think you could safely use in the 10 to 15 range, potentially larger, depending if you think the growth is going to be bigger for the company. So like maybe up to like a 20. So I stuck with 14. Terminal growth rate of 4%. So you'll see how that factors down below, and a discount rate of 10%. Now this is an interesting one because I like to use my own discount rate because that's the rate of return that I want to get, so I can understand what is there value in this for me. So I use discount rate of 10%. Now I did 3 different methods to value this company. I looked at EBITDA multiple method, I looked at perpetual growth method, and I looked at, there's also a third kind of maybe secret method that you can use, that you almost use like a rule of thumb formula from Warren Buffett and Ben Graham, and it's really cool how it works. So I'll show you how this works as we go through it. So with an enterprise value of 20.7 billion for the EBITDA multiple method, you get an equity valuation of 20.7 billion and some change. There's our shares outstanding. I found that online. Just plug that in. You get a value per share of $120, and its current share price is $90. If you use your perpetual growth method, $130, and if you use the Ben Graham Warren Buffett rule, it comes out to about $110. Now this one, I'll just show you really quickly how this is made up. So what you do to do this, and it's a really nice clean formula. So you use the latest unlevered free cash flow number that you have for the company. So in this case, it's $660 million. And then you multiply it by 8.5 plus 2 times the growth rate. And that number, if you divide by the number of outstanding shares, you'll get the value per share. And that came out to be $110. So by all accounts, on these 3 different discounted cash flow methods, we are underpriced in this stock. It's at $90. It's valued between 110 and 130 is what this says. So I want to take this a step further. So I said, okay, let's do a sensitivity analysis, because I mean, if you think about the EBITDA multiple, maybe it goes down to like 10. What does that do? Okay, well, look at that. Value per share is $92. If the EBITDA multiple is like 18, you're at 149. So, it's going to sway. And then, depending on the terminal growth rate that you use, or your discount cash rate, or your discount value, your weighted average cost of capital, that could also change it. So if that goes to like a 15, you can see how the numbers change there to 118 and 78 from the 121 and 130. Now, here is a sensitivity analysis for this one. So what you can see across the top is your terminal value, EBITDA multiple, and this is your growth rate. So if you assume a growth rate of 5% per year instead of 10 up here, all the way up to 15%, this is what your stock value could be. And this is if you use a EBITDA multiple of 9 going up to 19, this is what the value gets to be. So you can see at the very low end, if everything is extremely conservative, you're at an $82 share price. And on the really high end, you're at $159. So it's pretty clear to see that there is really limited downside risk to this one and a lot of upside. So, if you were to invest, let's say $1,000, and you got it at $90 where it currently is, and it went all the way up to, let's say the best case, $159, your $1,000 would be worth $1,767. So you would have made $767 off that trade in however long it takes to get up to that share price. So there's one other thing I want to mention in here, especially because what you have to really predict going forward is what that growth rate is going to be. Like how are the earnings going to show up in the next couple of years? Are we going to see huge growth, or we're not going to see huge growth? And I know a lot of analysts out there are predicting that the earnings is going to drop for the company because all the COVID stuff, people are buying new laptops or new peripherals, so like mouse and keyboard, gaming stuff, podcast stuff like Blue microphones, like that's owned by Logitech, for instance. So analysts think that that's not going to continue, and I can't disagree more. Because people are working from home more often these days. People want to upgrade their setups, get something more ergonomic. They're going to burn through keyboards and mice quicker. They're going to want new ones. We basically have, doubled the amount of offices that we have now, because now your work keyboard and stuff at work and all your peripherals, and then you want the same thing at home. So everyone just wants to upgrade their stuff. And with how big podcasting and YouTube and all these different things are now, and Logitech is in that game, with their microphone series and the webcams. I mean, there's huge growth ahead for the foreseeable future for Logitech, in my opinion. So this is a really cool one. So let's say you had a really bear case in this. Like, we're gonna go 10% loss on earnings next year, and then they don't grow, and they don't grow, and they don't go, and they don't grow. So they basically stay stagnant. They drop, and then they just stay stagnant for 5 years. What's their stock worth? Well, with your EBITDA multiple method, $114. With your perpetual growth method, $75. And you can see the spread here. The Ben Graham, Warren Buffett rule doesn't really work so well because the growth rate is negative. But if you make it 0, you're at $33 a share. So not so good in that method, but that method does not always work either. I would say when you can actually put a growth rate in, it makes sense. But when you're at a 0, it kind of falls apart. that formula. So what I was just trying to show you there is that I think that even if the sales don't go bananas and they kind of just like stay where they are, it's really not that bad for the company. So I think there's a lot of really positive things going on there. I think that they're going to grow quite a bit going forward. The other thing I wanted to show you, whenever I analyze a company, I always like to take a look at their latest quarterly report or annual report. In this case, this one came out in July, and I've gone through all the financials. I've read through this, in detail. But one of the really important points that I like to take a look at specifically is the management analysis, management discussion analysis, financial condition, and results of operations section, which is basically management talking about the company. So they talk about how they've been around for 40 years. They started as like a PC platform experience improvement company, and then they morphed to a multi-brand, multi-category company designing products that enable people to pursue their passions and connect to the world. So if we just go down here, some of the brands include Logitech, obviously, Logitech G, Astro Gaming, Streamlabs, Blue Microphones, Ultimate Ears, and Jaybird. So if you don't have one of those types of products, I would be very surprised. So they run in a lot of different circles. Here's kind of like the categories that they see themselves in: creativity and productivity, gaming, video collaboration, music, and smart home. And obviously creativity and productivity is huge. Gaming is again huge. Video collaboration, huge. Music and smart home, maybe less so, but still, they're probably decent little business areas. They talk about COVID-19 impacts to their business, and you know what? Like, it is what it is. It's just the same as every other company. I've read through it. I'll save you the pain. One other thing I'll show you in here. This is a really cool chart because it shows their earnings and their growth by segment of their company. So you can see pointing devices like mice. 2021 earnings were 183 million versus 120 the year before. I think these are just sales. Yeah, I think this is sales. Yeah. And keyboards, huge increase, 52%. PC webcams, huge boost, 81%. Tablet and other accessories, 72%. Gaming, 84% growth, absolutely massive. Video collaboration, if you're a streamer, if you're, someone who wants to collaborate with others via video, they're in it, 81% growth. Mobile speakers, they actually lost a little bit there, makes sense. Audio wearables, this would be like, headphones or speakers or whatever that are connected. Growth there, 63%. Smart home, small decline, but that's okay. Quarter over quarter, or year to year for the same quarter. And then other, they've seen some growth in whatever those things are. So all that to say, there's a lot of different areas that this company is operating in. So I think that diversification really helps them a lot because they're not a one-trick pony. I'm gonna buy this stock. For sure, I don't see any big downside. I see some really big upside. They're in the right kind of market. They're in technology. They're in gaming. They're in streaming, that kind of stuff. And their stock price is crazy low. So the other thing we want to look at is their stock price chart. So I'll just show you what I mean when I say they've gone quite a bit down. So this is the last 5 years. You can see 2017, $25 stock price. Just kind of a slow growth of this one. And then 2020 hit, obviously COVID, whoa, crazy times. And they were all the way up to around $132 a share. And then it came crashing back down to around $89.70, where it currently sits. This one is going to go back up. It's going to be in that $120 range very shortly, I'm sure. Probably in the next 3 to 6 months, I would say. So pretty good earnings potential. Small dividend, who cares? Doesn't matter. It's a growth company right now. And the fact that they even throw off a dividend at all is good. I personally don't love when companies like this put out too much in dividends, because it means they're not able to invest as much in the company and help to grow it. There's your PE ratio that I talked about. And this was the first flag to me. It's like 14.55. That's really low. Yeah, I mean, that's crazy. I mean, you look at Apple. I mean, it's going to be insane. 29. There you go. They're double the PE ratio. Let's do Microsoft. 38.39. Google, 30.06. So there you go. I mean, that's the tail of the tape. I just wanted to show you guys because I think it's a really great opportunity. It's at $90 right now. Should be valued at like 120, I would say. This one's a buy. So with that said, if you like this video and you want more content like this, please let me know. Don't forget to subscribe down below, and yeah, drop a like, subscribe. We'll see you in the next one.